Hi, everyone, and welcome to this installment of Mish's Market Minute, hosted by StockCharts TV. I am Mish Schneider, and I have a very interesting topic for today, and that is based on conversations that I'm hearing when I go on media, plus seeing on Twitter, and pretty much all over the place, is the wishful thinking that inflation has peaked. And yet, I really find that to be almost, in a sense, comical, because it's based on absolutely nothing other than some recent statistics which show that it has cooled, but not peaked necessarily. So there are particular areas that are still flying in terms of commodity prices. We're going to be looking at that. We're going to be really taking a broad look at all different types of commodities, from softs to metals, to precious metals, to the grains. So let's get started. Okay, so one other thing I want to say is that there's a lot of talk about the Federal Reserve and some of the soft economic statistics that have come out. And as a result, people think that the Fed will actually pause on their rate hike because they'll be worried about the economy more than inflation. But clearly, that is an erroneous assumption. And I think it's really important for y'all to understand why. Number one is, there is plenty of economic statistics out there that show that the economy is not necessarily growing, but not doing too badly, like ISM numbers. And two, and more importantly, was after Janet Yellen's startling and spectacular confession that they were wrong about inflation, you can bet your bottom dollar that they will, just like they ignored all the inflationary signs that they didn't want to see, will now ignore any slowdown or recessionary signs that they see in the economy and strictly focus on raising those rates to try to curtail inflation. However, the question is, can they? And that's what we're going to explore with these symbols right now. So let's go to the charts. Okay, so since we started talking about the Fed, let's take a look at the Fed's playground here. And that would be really having a look at what's happening with the long bonds, the TLTs. Clearly, anybody who thinks that the long bonds and the yields are going to collapse from here because the Fed is going to go more accommodative, this is not what you're seeing in these charts at all. And we were actually a buyer of TLTs on this reversal pattern based on a mean reversion and some very oversold indicators. But right now, not only did we work off the oversold indicators, we've had our rally, we had our gap this particular week, and now you can see that it's holding these levels, but with any other type of influence, whether it be a next Fed announcement or what have you. Now that we actually are in QT, we would expect that this might not necessarily break hard, but at least go back down to around 113, 114, and then go lower potentially from there. Certainly you're seeing it here in the real motion indicator on its relationship to the SPY. And certainly you can see here in the momentum that it never cleared the 50-day moving average, never even came close to it here on the daily price. So now let's go to the other indicator for bonds, which are tips. I got asked this question today. So this is the inflation protection bond. And you can see all of the bonds have, inflation has peaked. You can see that here because this actually has now gap down. The situation, of course, right now is that this could be setting up for, well, at least I wouldn't necessarily say a real motion inversion play, but certainly we've got it here in price, and that we broke down under yesterday and now we're back above it. So now what we can say is, based on this inside day, if this can get back through 118, 118.50, then perhaps if you wanted to buy a bond that would give you some protection against inflation because you really believe that the Fed can't control it, this would be the place to go. But both you can see right now are showing some kind of faith in the Fed's ability to actually do some kind of control. And that's with the narrative, of course, that inflation has peaked. We also felt we needed to look at the dollar. Now, I have an interest in the dollar right now because it's come off hard from its peak, and yet it's holding the 50-day moving average. This is UUP, but you can see momentum is really continuing to go south, as is its performance against the benchmark. So what makes me want to look at this is inflation will be somewhat tied to the dollar. People have been saying, how can we have an inflation and a strong dollar? And of course, in my research, 50% of the time, the dollar kind of does its own thing because it's so heavily manipulated. But what I will show you is the euro. Oops, I did not want to do this. Hold on. So in the euro, we have a situation just the opposite. We had, by the way, a classic, and I'm so sorry I missed it, a classic island bottom here. We had the gap down, a couple of days of work, gap up. That's a classic island bottom. Those are probably one of the most significantly bullish formations you can see. And we've had some nice follow through. Luckily, though, even though it's still well underperforming the SPY, you can see here in momentum, it's increasing. And guess what? It is pushing against the 50-day moving average. This is after having a good period here of consolidation between 98.50 and of course 99.60, let's call it. So it's been within $1. That tells me, and one of the things that we're planning to do is follow this if it breaks out over the 50-day moving average. With the euro going up, could the dollar go lower? Yes. Could that also aid in the inflationary narrative? Absolutely. Now let's go to the agriculturals. We're going to cover everything today. In DBA, oh, excuse me, that says DBS. What is DBS? Silver Fund. Didn't even know about that. DBA. In the DBA chart right here, people know that I have been very, very bullish. In fact, somebody reminded me that I was talking about this particular instrument when it was trading 13. And that was back in 2020. So that sure has been one hell of a run. But now where are we? This is mostly tied to agriculture, and we're going to look at the individual ones. Number one is our momentum has certainly come off, and so has our performance against the benchmark. But we're actually holding, I'd say, pretty much in a sideways pattern here, and I am not bearish by any means. In fact, I'm almost anticipating at this point that we could establish this new level of support that we've just had recently at around 2130, clear back over that 50-day moving average, and this time continue to go north. Now, one of the reasons is wheat, even though that's come off a lot too, unless all of a sudden miraculously Ukraine figures out how to grow a lot of wheat and get it out very quickly, we still have that problem, as well as the problem of severe drought here in the growing regions in the United States. So this actually corrected as well under the 50-day moving average. Momentum is coming back a little teeny bit, underperformance, you can see here. And again, if we can get back over, say, this high, which would be over 11, I would not discount that this too can go higher. So you have pretty good risks here in wheat and in DBA. And now let's look at soybeans, which looks totally different. With soybeans, your momentum isn't quite matching up there. So I would probably want to wait for a little more momentum in this real motion indicator. But you certainly have your price consolidating over the 50-day moving average. So to me, this also looks pretty clear that if you don't want to just buy it against the 50, buy it once it takes out this Bollinger Band, the solid line here, which would be over 28.90, and then risk to under the 50, because that surely means that all the food commodities, short of this one right here, will go back out of control. And that will certainly impact all of the numbers, the CPI numbers, the PPI numbers, and of course, what happens with inflation in general. Now, corn probably, well, it kind of looks a little bit like wheat, not quite as strong, but with corn too, we're going to be looking for some kind of a mean reversion trade in momentum. Remember what that means, right? It goes below the Bollinger Band, comes back through the Bollinger Band, and we're kind of seeing it potentially here in price. So if you wanted to follow some kind of a mean reversion trade, you would look at your ACP plugin, see if it can break out over the Bollinger Band, and that would also mean that this would probably be clearing the high of today, which is 27.80. So that would be another thing to look at in terms of corn. Now let's move on to the softs. So we have two. Instead of showing you the futures, obviously, I'm showing you the actual instrument itself in the ETF, but the first one is sugar or cane. Now, sugar futures, I can tell you, has been hovering up and down and all around the actual 50-day moving average. And on the weekly chart, it's holding up very, very well. So the 50-day moving average is really not necessarily going to be the best thing for you to be looking at here. But in cane, you can see it's respecting it. So what I would look for is, if you watch the sugar futures, is number one is I want the momentum to come back because it started sort of waning off. Two, excuse me, is I'd like to see sugar futures in the spot trade above 1945. And three is I probably would like to see this clear about 985, 990 on a closing basis. But I still think that sugar is actually eerily quiet considering oil prices continue to go up. Now, coffee, as we've seen through JO, also had a spectacular run. And now we just had an inside day after a gap up and a close back under the Bollinger Band. So it's possible that this will come off a little bit. Seasonally, this is not really the time for coffee, but it has had this impressive run over the last several days. More importantly, if you put the whole picture together, as I said, what you can see is not necessarily that food and soft inflation has peaked. It's just come off. There's hardly any kind of tremendous down move happening right here. Now, let's move on to the oil market. I'm sort of out of order from what I've done here in terms of your slides, but I think it's really important to go through this in a logical sequence. So today was the big day that OPEC met, and apparently they agreed to increase their production. They also have agreed to get rid of Russia, but we know Russia is also importing oil to China and to India. And so considering that there was going to be a talk of more output of oil, this actually went up on the day as opposed to down. That tells me that if we can go much higher from these levels here, particularly if we can take out the high of 88.32 from the other day, that talk of $120 a barrel to $130 a barrel and possibly $150 a barrel doesn't look so crazy. But more importantly, where's the control on inflation? Because as we know, with oil prices being high, food prices are soon to follow. And that's really been the trajectory here. We had oil prices high, food prices high, they were kind of going in tandem, and everything just got super more expensive. Let's take a look at energy in general. And that too certainly doesn't look all that horrible here. Basically, what you're getting is consolidation up at these higher levels, albeit with somewhat of a mean reversion, which is why everybody thinks this is over. Now, would I necessarily want to be a buyer? I'm not sure. I don't really like to chase momentum in these things that are very overbought. But nonetheless, more importantly, again, for the actual idea of inflation, so far, I can't tell you any reason that I'm seeing that it has peaked. Now, let's also go to UNG. Natural gas has been really hard to trade. And we had that spectacular trade in our models, and we've gotten out. We're really flat now, not only in the discretionary, but also in the models. I wouldn't touch this because I see the momentum declining. I see it starting to underperform the SPY. Nonetheless, it's not exactly cheap. That's my point. And now just to kind of cover that area, let's also take a look at coal. We're going to take a look at coal through Teck. Actually, we could look at it through KOL, but I'd rather look at a company. And this too, maybe we're going to see some kind of spectacular double top, but we have to have some evidence of that first. Best thing I can say that maybe in terms of coal, we have peaked a little bit here is this sort of mean reversion trade we're getting here in the close. Let's wait for the momentum to go down before we say, gee, this might be a good short against these double tops. But that would maybe be the first sign that it's starting to look more than just a normal correction, but just a little bit more tired. All right, let's move over now to the metals. So let's start with some of the more ancillary metals, more the industrial metals. Let's go to JJC. Now, JJC, copper, had a big comeback today. You could see that after all this consolidation and pushing against these moving averages, just gapped up and took off. Now, in terms of the momentum here, it's starting to clear the 50 as this is, so there's no divergence. We can see that it's starting to come back, outperforming the SPY. But more importantly, again, where is the there's no more inflation conversation coming from? These people are, as far as I'm concerned, using a lot of wishful thinking. And then that really kind of is for the palladium. Let's take a look at for the copper. Let's take a look at the steel. We're going to look at that through X. Now, X really hasn't done very much. Now, this is more tied to the housing. And as we know, even though housing is still robust in terms of existing home sales and in terms of median house prices, the actual new construction has come off. So maybe this is the one spot that we can say, oh, steel prices are lower. So in terms of that, and certainly in the housing and the used car market, we have seen inflation come off, but that's not what's going to create tremendous disruption, is the housing market, because we're not looking at anything like 2008 or the used car market, other than people want electric cars and they have to wait for them. So that really, to me, is interesting. And then if we just sort of look at it from a broader base at XME, which is the ETF, of course, you can see it's smack dab in the middle between the 50 and the 200. Momentum is okay, outperforming. So this too really needs to do more work. If it gets back over 57.50, again, like I said, really just don't believe what anybody's saying about the end of inflation. I'm just not seeing it. A couple more to look at in the metals. Palladium. This is very untradeable, but nonetheless interesting because palladium also has come off. A lot of this has to do with supply chain, but also you can see that we haven't really gotten the momentum move here, but we did get an interesting mean reversion trade. And now if we can get back over, let's say, these levels here, again, I would never trade this one. It's almost an impossible ETF to trade because the volume is so light, but it's more information. If we just kind of put this together here, like I said, we got about a 50, little bit more % correction, and now we're coming back. To me, whatever respite we got in inflation in these industrial metals is now over. And then one more thing to just show in that whole area, and that would be DBC, which is actually oil and metals. But DBC, of course, is on a tear. And DBC, you can see, just made a new high. So again, no more inflation. Yeah. Now, finally, I want to end with gold and silver. Gold is also still so outrageously undervalued compared to the level of commodities, compared to the level of equities. This is why we've been in gold. We're holding gold. We're actually making money in gold. And I would definitely like to see what it does from here. The high of this week, this move right here was 174.41. Today's high that I'm talking to you is 174.45. We closed just below it. But keep your eye on this for now too, because I still think this has potential. And rather than buy gold at this point, if we really think we're going to go into an inflationary standpoint, I would almost rather see you buy silver. Silver is still under both moving averages, but nonetheless, it looks like it's starting to come up in momentum. And the same kind of thing. This high was 2065. This high here, 2060. So if it gets through 2065, I think you have a pretty good risk. You could probably look at about a risk to under 19 50. One more, I'm sorry, I forgot about GDX. Probably the most interesting to me right now in the metals and the precious metals would be the GDX. I keep doing that. I keep holding, thinking that I'm going to have one chart instead two charts come up. Today was a big day because it just cleared back over the 200. It's also cleared back over the 200 here, which means as you hear this tomorrow, if this thing can take out this high right here, which is 33.57, probably can even wait to fill the gap at 33.99. This to me looks like this too has bottomed, and we should be able to start to see a move back up to 35 or even higher. That's also going to be very bullish for the rest of the metals. So that's a wrap for today. And I just want to make a quick note that we have been doing this for StockCharts every week for a couple of years now, but we're going to go into a different schedule where I will continue to do all of the special projects that StockCharts has, including your daily 5. And this weekly video will be cut back to more like once a month or every 6 weeks so that it becomes more of a special event. So thank you so much for all of your generous time. I look forward to seeing you again, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.